The Magnificent Seven not looking so magnificent here at the end of this week. The QQQ selling off almost 3% to the downside here on Friday afternoon. Hey, I'm Dave Keller with Market Misbehavior. Today we're going to talk about those mega cap growth stocks, why their movements are so crucial because of the significant weights that they bear in our major benchmarks, the S&P 500 and the Nasdaq 100. We'll talk about the performance since the July peak. We'll look at each of those 8 charts one by one, talk about some key levels and outlooks, and why they should be charts you follow closely in the days and weeks to come. Before we get to those charts and the implications, here's one more thing I wanted to tell you about. I spent many years earlier in my career working for large financial institutions. And when I left the institutional world, I remember thinking, what am I going to do to replace these big, expensive, but powerful institutional investing platforms that I've had access to this whole time? There is an option now for individual investors and financial advisors, and it's called Koifin. Koifin really combines some of those great capabilities of the big, expensive institutional platforms, along with some capabilities really optimized for financial advisors and high net worth individuals, and puts it in a very low cost, underpriced package on a web-based platform compared to the possibilities that you can achieve by using said platform. One of the features I love to use on Koifin are the ETF holdings. You can take an ETF, you can, like the QQQ, you can look at the biggest weightings, you can look at weightings by sector, you can run some basic attribution analysis. So for ETFs that you own or that you're considering owning, doing the due diligence of really understanding the exposures you're going to get is super important and super powerful for your portfolio. If you go to marketmisbehavior.com/Koifin, you can get 10% off any new membership. I hope you will check it out, and I hope you will find it as meaningful and powerful and impactful as I have found myself. Now let's get back to the charts. All right, so we're looking at the chart of the Nasdaq 100, the QQQ. Here's the thing, right? The chart of the Q is actually displaying what we call a bearish island reversal, and that actually just was completed on Friday, November 15th. And that comes after a bullish island reversal that we saw at the end of October, right? So an island reversal, think of it as you're looking at a map from above, right? Sort of a regular map, and you have like the island, there's the mainland, and then you have the island sticking apart there. That's created on a chart by having a gap lower and then a gap higher. So there's your little island, again, if you're kind of looking down at a map from the top. And that's a bullish island reversal, a gap lower, and then a gap higher. So think about what that means, right? Something happened for stocks to be revalued lower from one day to the next. We have a little bit of price action for a couple days, and then we have a gap higher. So something changed to revalue stocks lower, and then soon after something caused stocks to be revamped higher, or revalued higher, in this case the elections, right? And that was Wednesday after the elections were announced on Tuesday. So then we have a couple days of further price action. Then we have another gap up here. Great, this move up here, just above the Q's around 508. And that was where we got back to on Thursday's close. And then Friday we gapped down. So now we have a bearish island reversal, a gap higher, some price action, a gap lower. So the most recent signal now on the chart of the QQQ is bearish. Now, is it a climactically end-of-the-world bearish kind of signal? It is not, at least not yet, because Charles Dow would tell you we're still in an uptrend, and we're in a primary uptrend according to Charles Dow because we're making a pattern of higher highs and higher lows. So we made a new high, right? Made a new all-time high where the Qs touched 515 for the first time about a week ago. But from there, we've now rotated back down. But we're still above the October, late October, early November swing low around 483 to 485. So as long as we would hold that, as long as we hold an ascending 50-day moving average going into next week, primary uptrend is still in place. And that's how you have to try to differentiate a short-term kind of noisy pullback versus a more significant drawdown that has more signs of deterioration, more broadly speaking. Before we get to the charts of the Magnificent Seven and friends, as I call them, the 8 leading mega cap growth stocks that I like to follow, I just want to show you on the market carpet, which is a feature on the stock charts platform, great kind of a simple heat map that shows you the movements of all the different S&P 500 members from one day to the next. So this is the change from Thursday's close to Friday's close. So while the Nasdaq 100, the Qs are down around 2.5% here on Friday afternoon, note that a number of these mega cap growth names are now down a little more. Meta currently down around 3.7%. Amazon down almost 5%. Microsoft down 3%. NVIDIA down 4.3%. So you have some of the largest names driving things lower. And here's the kicker, right? This heat map is sized by market cap. So the larger the box, the larger the market cap. But it's not exactly scaled correctly, because if so, then the entire screen would be NVIDIA, Apple, Microsoft, and the other kind of top 10 to 20 names. And then there would be boxes that you couldn't see because they were so tiny compared to the dominance of these largest names. So if you accurately scaled the size based on the market cap, the biggest names would be the entire visualization. That's not very helpful. So it's kind of a graduated scale. And so the biggest names are kind of scaled down a bit. The smallest names are scaled up a bit. So you can actually see some of the tickers when you get down to the smallest names like Prudential or Ralph Lauren or EMN or one of those, right? So having said that, the reason why the benchmarks are down on a day like today is really in no small part, if not mostly, because of the deterioration in those mega cap growth stocks. And this is why the Magnificent Seven names are so crucial to follow, to analyze, and to understand. Because if you want to understand what's happening with the benchmarks, you really just need to understand those biggest growth names. And while other stocks could provide opportunities and other stocks could provide potential upside and or at the very least a place to ride out a period of market uncertainty, the direction of the benchmarks are still dominated by the mega cap names, those biggest names. Here's another thing to think about before we look at these 8 mega cap growth stocks. If you look at the July peak, right? So here on the chart of the QQQ, there's the July peak here where we pushed just above 500 on the Qs. You can see obviously in month of November, we've pushed above there and pushed above 500 for the first time, but now we're kind of right back below. So the Qs are actually slightly below that July peak. And that's what this chart right here is kind of showing you. I'm just going to refresh this because we had a little bit of movement since I first brought this up. Yeah, pretty much the same. So we have the Qs that are essentially now flat, right? They sold off a bit off that July peak into early August. This is the red series I'm looking at. They overall moved higher to finally make a new high in November, but now all of a sudden they're back to that same level of the July peak. If you look, the S&P has outperformed the Qs over that period. The Magnificent Seven stocks have outperformed the Qs. So the largest names have had the best returns. But here's the kicker. With today's sell-off, the equal-weighted S&P 500 has actually outperformed the Magnificent Seven. So while, to my earlier point, while I would say that the fact that the RSP has done so much better off the July peak tells you there are areas of the market that are actually doing fine. Because that's equal weighted, that means the other names have a much bigger weight and the mega cap names have a much smaller weight. So that tells you that things outside the Magnificent Seven are actually doing okay in some cases. But with all of them rolling over, the weakness in the Magnificent Seven is what's going to drag the benchmarks down the most, right? That's your real area of, should be an area of focus. So let's look at these 8 charts rapid fire style, but I will tell you, you can bucket them very easily into 3 buckets, and I would think of them this way. There's a handful of stocks like NVIDIA. The first bucket are the names that have already broken above their July peak. And I will tell you with those, it's all about this current pullback. It's where this pullback ends, whether we can confirm a higher low, whether we can remain above upward sloping moving averages. That's the question for charts like NVIDIA. The second group will be stocks that we've still kind of not seen the breakout, right? Charts like Meta and Apple are actually still below their previous highs. Haven't made a new high for the cycle just yet. So the question is, what's it going to take for those stocks to actually push higher? Then you have the, I don't want to say the WTF charts, but it's the outliers, as it were. Maybe is a different way to say that. The ones that don't really fit into either category. Microsoft, it's arguably in a clear downtrend. Tesla, which is a choppy, noisy chart, accelerated to the upside, gained the most out of this bucket, or out of this group of stocks post-election, but now has lost the most this week, sort of giving back a lot of those previous gains. Let's look at these buckets one by one and talk about some key levels on each of these 8 charts. Here's the chart of NVIDIA. We can see the first thing that jumps off the page at me, we have the June peak. So NVIDIA actually topped out in June, not July, for what it's worth. We retested that resistance level around 140 in mid-October. We pulled back and then made the new high. But note how the momentum was weaker. So NVIDIA is one of the few of these stocks that's showing a very clear bearish momentum divergence. Another example of that would be like back here in March of 2024, where we made a new closing high on weaker momentum. That's kind of what you're seeing here. What that usually suggests is that we're at the later stages of the uptrend, not at the middle stages of the uptrend. We're kind of sort of near an exhaustion point, and when we make higher highs on weaker momentum, that implies that there's not enough momentum behind the buying or behind any accumulation, and distribution is really starting to take hold. Now, on the chart of NVIDIA, I would immediately look to the late October low, which is around 132. I would also say that the 50-day moving average lines up right there. So that's the level I would say NVIDIA would need to hold to still remain a very clearly bullish phase. Netflix has probably had the best run out of this entire group. Netflix and Amazon are the two strongest charts so far in the fourth quarter. You can see that Netflix actually gapped higher to make a new 52-week high in October, has continued to push to new all-time highs, testing 840 now for the first time. I would argue that there's nothing bearish on this chart besides the fact that we pulled back a little bit, and today's pullback here on Friday actually appears to be bringing the RSI back below the overbought threshold. And while that doesn't necessarily mean the end of the world, it could mean that there's further upside to be had later, but usually when you become overbought and then come out of that region, that usually means there's at least some sort of pullback sort of in the cards. Might be a short-term pullback, but it's usually some sort of pullback. So suggest Netflix in a position of weakness going into the next week. Amazon, kind of a very similar chart. Amazon, again, is one of those that actually has broken above its new highs. I would say Amazon and Netflix, again, the two of those have been the strongest performers in terms of their technical configuration so far in the fourth quarter. Similar to the chart of Netflix, we can see we became briefly overbought here in November. We've now gapped lower coming out of that overbought region. I would say unique to Amazon is this big round number thing, or a big round number phenomenon, as it were. July, we peaked out right at $200 a share. We finally broke above there earlier this month. We're now right back to $200. Big round numbers like 100, 200, 1,000 often have meaning, and that's a human thing. We see big round numbers and we tend to use them in our trading, in our approach, in our risk reward calculations. And so usually expect some sort of movement around 200. So I would say for now, can it hold 200 below there? The 50-day moving average around 191 is what I would be watching. Here's the second bucket of stocks, which are three names that were really still waiting for the breakout, right? They actually had a nice rally. So something like Meta actually broke out in September. And this was a big base breakout, meaning we had a long sideways period of a very consistent resistance level around 530 to 540. We finally broke above that with authority in mid-September. From there, we moved higher, and then we hit a big round number of 600, and we've tested that 1, 2, 3, 4 times in the last 6 weeks. So 600 is the level. So the chart of Meta is one of those that I would argue has not been particularly bullish post-election, right? Even though you had a bit of a bump, it wasn't enough to push Meta to new highs, and that's what I would say the sustainability of the gains that we've experienced going into the elections. If you want them to sustained after, you need Meta and Apple and Alphabet types of charts to keep going, right? To break out and actually continue to follow through. With Meta, we're actually still waiting, right? And even though we are above the July peak, we've stalled out around 600, and after a number of tests, we're clearly failing to hold it. Today, as of Friday, we're actually breaking below an ascending 50-day moving average, and I would say going into next week, do we get any rebound off of these early November lows right around 560? And if not, that's where I would look to further support around the 200-day moving average around 510. Apple is another one. Here, the level's around 235 to 237. That's where we hit a peak in July. We had another retest there in mid-October. Again, no real significant bump post-elections. This is sort of remaining right around the 50-day moving average. I would say for something like Apple, until and unless it can break out above 237, this is a neutral chart at best. And if we break much further down below 220, I would say that makes a new pattern of lower highs and lower lows pretty bearish. I would also look at the RSI to see if that holds 40 on any further deterioration next week. Alphabet would be the third one. Again, it did break out in late October, but it's still well below its July high. So I sort of put it in this third bucket of still waiting type of charts. This is an interesting one because we gapped above resistance in late October. We pulled back after the elections. We retested that previous high, but didn't break out. So very similar to Meta in that the post-election bump really didn't take us through resistance. It just took us up to resistance, which is not a particularly bullish development. You want stocks like this leading names to actually follow through. So I would say for now in the short term, can it hold that breakout level, which is around 168? The worst case scenario would be a break below 163, which would take us below the 200-day moving average, which has not happened very often in the last 12 to 18 months. Finally, we have this last bucket, I would say the question mark bucket, to keep things G-rated here on the Market Misbehavior channel. I would say with the chart of Microsoft, and I didn't extend this trend line, but if you do, you can see that the high in July, the high in September, we had a failed breakout above that trend line in October. We had another failed breakout apparently over the last couple weeks, because every time we get above that trend line, we fail to have upside follow through. Note how here we did not make a new swing high. Look how here, again in the month of November, we did not eclipse the October high. So stocks unable to make new highs. It's no longer in a primary uptrend. It has to be something else. I would say, again, at best, this is a neutral chart. At worst, I'm looking at that 406 level. That's actually a Fibonacci level, looking at the broader advance from 2023 up to the July 24 peak. Does 407 hold? And if not, much further downside potential to be had there. And finally, good old Tesla. Probably, I mean, again, in terms of pure price returns, the best move in November so far, and that's because of the spike we had after the election, sort of the Trump bump, as it were. If you look at what's happened with the chart of Tesla, we did become overbought about a week ago on those gaps higher. We now have become no longer overbought as the RSI pulls below 70. Tesla, as choppy and noisy as it is, I would say still in a primary uptrend, and it would actually have to deteriorate quite a bit to change that picture. With a chart like this, by the way, what I like to do is look at the previous breakout. So what I would do is take this particular pattern here, which is sort of this range. That combines the July, September, and October peaks. It also respects the fact that that was a pretty meaningful price gap there. And I would say as long as that holds on a pullback, sort of that 260 to 270 range, the primary uptrend arguably still positive. Note how the 50-day moving average is going to kind of be right in that range within the next week or so, assuming a similar trajectory. And so we have what's called a confluence of support right around that 260 to 265 level. That implies there's quite a bit of downside to be had, and that's the problem when a stock has gone vertical. It has a lot of room to come down, still be within a primary uptrend, but at least that gives you a sense of potential downside risk in a very volatile name. So there you have it, the Magnificent 7 stocks not looking so magnificent from a technical perspective here as we wrap this week. Which of those 8 stocks do you see as providing the best opportunity in your portfolio in the days and weeks to come? Make sure you drop a comment below and let me know. By the way, if you want to learn more about some of the techniques that we used, if you want to improve your decision-making using technical analysis and behavioral investing concepts, our Market Misbehavior Premium memberships may be the perfect gift to yourself as we get into this holiday season. You can go to marketmisbehavior.com/premium. Make sure you use the code YouTube to get 20% off any plan for the first 12 months. For Market Misbehavior, I'm Dave Keller, and remember, it's always a good time to own good charts.